Welcome back, everyone, to Living Your Greatness. And today I'm really excited to welcome a new guest to the show. His name is Rob Bruggeman. So, Rob, without further ado, welcome. Good to see you today.
Yeah, thank you. Good to be on your show. I like your approach and can't wait to answer some of the questions.
I really appreciate that, Rob. I just want to start this conversation. There's been a lot going on. If we look back, even last week, in the financial world with the war and how that impacted the stock market, it has driven so much fear. So I'd love to kick off this conversation. If you could share what you are seeing right now in the financial world and how that is also impacting not only people's financial investments, but even also their emotions as well.
Yeah. So that's a simple question with us. We can spend an hour just on this alone. Yeah, there's a tremendous amount going on. Yeah, the world is rapidly changing. It was even before the situation in the Middle East. But that by far now is probably the biggest factor from an investment perspective. So you kind of have two things. You've got the backdrop of geopolitics, complete change in global trade, US dollar, all the stuff you've probably heard a number of times in terms of why is gold going up, as well as other metals. But then more recently now, you've got the situation in the Middle East. And so that one is much more concerning. I mean, I'm concerned about everything, but my concern really relates to what is going on. I can't change it. I acknowledge that, so I don't actually get upset about it. What I try to do is figure out ways of profiting from it. Um, Gold, silver, copper, the thematic reasons that they're going up, I think are great. And I've benefited from them. But more recently, then now we've got the Middle East situation. And that one does really scare me a bit. And I'm concerned because it's unpredictable. Um, so my background is primarily equity research and then investment trading and hyper analytical. And so really, if I talk about what do I do and what do I believe in, I I basically invest and I try to invest in a way where the odds are stacked in my favor. And the way I do that, and this started when I worked as an analyst, but then on the proprietary trading desk for one of the big Canadian banks. Effectively, what I did is I took in as much information as I could from as many sources. So that included our other equity analysts, the companies, what's going on in the market, reading things, talking to people. And you take in all this information, you say, okay, what does that mean? And you gauge the odds. So, what are the odds that something is going to happen? And then how do you position yourself to profit from that? And you very much look at what's my risk and what's my reward. And so that, put very simply, is kind of my approach to everything, whether it's mining, investment, or anything else. When you look at things through that lens, then uncertainty equals risk. So the situation in the Middle East, not just because of Donald Trump, who is a bit erratic and unpredictable, but more so the Iranian regime, massively unpredictable. And you've got the two sides, and how does that play out? I don't know. And so therefore, the risk has gone up severely from where we were just say a month ago. And so you're seeing that have an impact on the dollar, interest rate outlook, certainly gold, silver, the other metals, and then equity markets in general. And we're in a situation where risk has gone up. I've been surprised that equity markets have been, especially the US, have been pretty calm. Normally, we've seen the US dollar tick up. You expect to see that during a flight of safety. T-bills, you haven't really seen too much panic. And so hopefully that's a good thing. But I kind of view it right now where you still have, until we see, say the US pull out of Iran or a ceasefire or something, we're still in an environment right now where you do have elevated risk. Yeah. And then uncertainty on what is the reward if you go in. So it's kind of a situation where until we see more information, I kind of pull back and say, okay, well, let me see how this plays out. But I'll be honest, I don't like it. I like more predictability. I like situations like before. I like the outlook for gold because there are these massive tectonic shifts happening with the US dollar and trade policies. And, as long as the Republicans stay in power, that's going to continue. So that's good for gold. It's pretty predictable. US dollar is going down. So I like situations like that. The Middle East right now, I don't like because hard to say, where we are in a week or a month or 6 months, but it does have the potential to be an oil shock and, very bad for the global economy. And so that's my biggest concern. And hopefully it doesn't happen.
I want to dive a little bit further. When there's war, it brings a lot more uncertainty. So I would love to hear your opinion on when you look back of other times in history when there's been wars similar to this, obviously a different war. What have you done in the past as an investor or a trader to position yourself or react?
And so in terms of what I've done in the past, I'm agnostic. And I basically just try to inform myself. So again, I take in all this information, try to predict outcomes based on all this external information and maybe some intuition and past experience as well. But I just look at it and say, where do I think this is going to go? And then how can I profit from it? Normally in a situation like this, I would look at it and say, okay, the US has already expended billions of dollars of missiles and other bombs, etc., in Iran. And so, for the US defense industry, that's going to mean some growth. And then when you talk about certain strategic metals used in defense, such as tungsten, antimony, these things are going to be very good for demand. Probably, if you're looking at something, not that this is really my area of expertise, but if you're to look at companies with technology where you can take down cheap drones, obviously there's heightened demand for that. So that's kind of the way my brain tends to work, where I say, okay, what opportunities is this going to create? What risks, obviously, what do I need to get out of? But that's kind of the way I look at things. So when you boil that down right now into, do you buy, hold, or sell? It depends on what it is. But again, because of that uncertainty, which equals risk, I'd say I'm in the hold camp. I'm positioned for a number of things. I'll hold that, and I'm optimistic that the thesis behind those investments plays out. But I want to see less risk, i.e. more certainty, before I deploy more capital. Now, the market is awesome because, the market reflects all of this information as well, right? And so when you say there's more risk, that should be reflected in the market. I don't know that it fully has been. But normally what you'd expect is more risk, market goes down. Now you've got more upside potential, less downside potential. So that's kind of the way you'd expect things to work. So overall, the market is pretty good. It's the macro market is efficient long term, but not necessarily in the short term. And you just look for opportunities. But right now I kind of see, it's high, sure, it's high reward, but it's high risk. So when I see high reward, maybe medium risk or low risk, I like that much better.
I appreciate you sharing that because, again, like sometimes investors always say buy or sell, right? They think there's two options. It's nice to hear your perspective of where you stand, how you are playing it out. And I also feel it's important, even people that are watching right now, if they're feeling a lot of fear where they're not confident right now and making an investment decision, remind them that they don't always have to, right? They could simply just hold. And obviously I'm saying hold depending on what the investment is and, what they currently know about of that, hopefully a company that they've done a lot of research on. So that being said, I want to stay with you here you spoke a little bit about gold and we've seen incredible, I would say 2+ years where dramatic moves to the upside. But sometimes what investors I find sometimes forget is they could get distracted by these uncertainties by the day to day or the week to week. And so I would love to get your opinion on when I look at, let's say, gold or silver or even other commodities. In my opinion, even though there's a lot more uncertainty in the broad market with geopolitics, nothing has changed for our metals. If we were to zoom out of even like the war that's really unfortunate that's going on, what do you see long term for these metals?
You said something before. If I can just go back to the previous question, just add a little thing. I think it is important if you allow me. So even though I say hold in the current market for investors in general, and one of the things I do, when I say hold, it means, probably don't invest more capital. But I think it's a great time right now to look at what you have, look at how you're positioned, and think about switches. So, everything's selling off. You can shift your risk profile and reward profile, even without any new capital deployment. So, maybe you've got a dog exploration stock that you may need to get rid of it anyway. Sell it, maybe buy a producer which has sold off massively, or buy an ETF that's diversified. So the switches are a good idea right now. And I do a bunch of that, and I think it really helps. The hold is more, am I putting new capital to work or taking capital out of the market? So just wanted to add that because I think it's, there are always things you can do. Then to answer your question, overall, let's start with precious metals, which is really driven by gold. So gold is done very well. There are very valid reasons why gold has done well. And if we look historically, in the big bull markets in the 70s and early 2000s for gold, we saw the price basically go up 6 to 7x. And so that means if that were to happen again, we could see gold go up to 10,000. And before the situation in the Middle East, I thought that was very plausible, because I see all of these factors continuing. And those factors include a number of things, but very simply, governments around the world, and certainly in all developed nations, are spending way too much money. And when you do that, you're, call it printing money, but you're devaluing the value of that paper money. And, it leads to inflation, but it has a number of other impacts as well. One is you got to service that debt. It continues to grow and grow. I understand why politicians are doing it, because it's a great way to get reelected. People love handouts, and they love collectively living beyond their means. But I don't believe it's sustainable long term. My personal belief is that governments should spend more than they take in only at times when you've got an economic downturn, or when there's productive reasons for that capital. In other words, you take money financed by debt, just like a company would, you invest it in something that you think is going to elevate the GDP, so you're actually getting returns out of that. In many cases, in my opinion right now, money is being borrowed and it's not being put to productive use. It's not going to grow GDP. So that's problematic. And so I'm a huge fan, because of that, of hard assets. And gold very much is a hard asset, as is real estate, other metals, oil, infrastructure, pipelines, things like that. So I have a big mining portfolio, but also a number of other things. But it's very heavily concentrated towards hard assets. And that's because they protect that purchasing power of money. And that's important because, we talk about gold going up. Yes, gold is going up because of demand from central banks, a number of other reasons, even now stable coins, potential new source of demand. But, equally important is part of gold going up is if we're talking in US dollars, it's actually the US dollar going down. And so my thesis, has been that gold will continue to go up if we're talking about US dollars, just because the US dollar is going to weaken because I don't see any end in sight on this massive spending. The US just went through 39 trillion in federal debt. And, interest costs, the service costs of that is going to now be, $1 trillion a year. It's a problem. But that said, now we've got a situation, again, the Middle East, where all of a sudden you've got potential for an oil shock. What does that mean? It's not just oil and natural gas. It's things like fertilizers, plastics, shipping fuel, all kinds of things, and just increased risk. So, what happens in a more uncertain environment where you don't know what your input prices or your costs are going to be is people delay investment decisions, hiring decisions, stuff like that. So that's where you can get a big downturn. The reason I mention that is not only that, if you get an inflation shock, which the market, is now pricing in, but only a short-term one, all of a sudden you've seen the central banks pivot away from we're going to cut rates more to, hey, we may have to start increasing this. Hopefully that is just talking down inflation expectations. But if it does happen, as much as I love gold, that's bad, because the one problem with gold is it doesn't pay any interest. So, if you park your money in T-bills or bonds, you're going to get paid to wait. Doesn't really cost you anything to hold them. Whereas with gold, it's harder to hold and you're not going to get a dime of interest. So, as we've seen in history, for good reason, when interest rates go up, then appetite for gold goes down. So that is, all of a sudden now a big headwind that we have. And we have to see how it plays out. So I still think that certainly the deficit debt arguments, upsetting global trade, and then US dollar debasement and diversification, I think those things are going to continue to happen. The reason gold is pulled back now, and the reason I am watching carefully is if there's an oil shock or there is inflation, even just continued flight to safety of the US dollar, that's a setback for gold. So gonna have to wait and see how that plays out, and hopefully short term we'll move beyond it, and then I could very well see gold going to 10,000. The other thing I'll mention is, fundamentally it's hard to say, what gold should be worth. Some of it has been a momentum trade, and momentum tends to overshoot. So, not only could gold go to 10,000 afterwards, it could return to 6,000. I don't know. Kind of have to watch the markets and adapt. Hope for the best, but plan for every scenario. So that's gold. I guess in terms of other metals, again, right now there's the risk element. So I love the long-term outlook for copper with electrification, EVs, and now AI. I think there's going to be massive new demand for copper. But in the short term here, if there's economic uncertainty, copper very much is an economically driven metal. And so, I've kind of taken a step back from things like copper, even silver, which has a demand element as well. I can see why it's going down. I favor silver over copper right now, as much as I love copper in the long run. You look at silver, that industrial component comes from primarily solar panels. And if you've got, massive unrest in the Middle East, which could continue for a long time, and, a higher risk premium on oil, natural gas, that's pretty good for solar. You've got this heightened demand for electricity, uncertainty and higher costs likely with oil and natural gas. And so, I think the yeah, the potential here is quite good for solar. And so that benefits silver. So that's kind of the way I think. It's like, gold, I think, is good. Silver better than copper, albeit very volatile. Can keep you awake at night to some extent. But yeah, like those. And then, like I mentioned before, defensive metals. There's going to be a lot of spending on things like missiles, anti-drone technology, et cetera. And so you just look at what metals do those things require. So tungsten's been hot. Well, I think it's going to stay hot until you get new supply coming on the street. The demand picture just got better.
I really appreciate that breakdown of all the metals. I want to kind of stay on the topic of sometimes investors, again, get so stuck in the day to day or the week to week. If we look back in the last 5 years, gold is at 1800. It's now, okay, it's obviously been down in the last couple of weeks, but still above 4,400. That's phenomenal. Like that move. It's supposed to be that boring pet rock, right? Which just preserves value over time. When we look at silver for 45 to 50 years, it was just so manipulated and constrained at a price of between $15 to $25, right? And look at where it is now today, where it's holding above $70, right? That's phenomenal, right? I would love to get your opinion on what does this mean though for the mining space?
Let's start with the producers. So I like the producers, especially in the precious metal space right now. And the reason I like them is because they're positioned to benefit from the commodity price. On top of that, if you look at valuation, say, of the Canadian listed senior producers, even before this correction or pullback, they were pricing in about 40, I think it was about, when I checked, it was probably 2 weeks ago or so, or a few weeks ago, they're pricing in about $4,300 gold. So already the market had some skepticism. So it wasn't a situation where they were being valued based on gold going higher than spot. It wasn't like they were valued on, okay, $6,000, $7,000 gold. No, they're discounting what gold spot prices were telling us and probably reflecting the gold forward curve, right? Which is an expectation of prices. So, if as an investor like me, if your thesis is gold prices are going to go higher, then that means, my belief is they're worth this. The market is pricing them here. And, if I'm right, that's how I make money. It's the nature of investment. So I still believe that with the producers. I think, I favor producers over explorers right now. And the reason for that is because the one thing that has always happened and will happen and is happening again is when metal prices go up this much, then costs will fall. So miraculously in early 2000s, when gold was trading at $250, $300 an ounce, producers are still making money because your all-in sustaining cost was, maybe $200. Otherwise, you're out of business. And if you look at gold prices over time, they've gone up, but so have costs. And more importantly, so has the cost of capital, or the cost of actually building a mine. So the one thing I find quite annoying these days is when you have an exploration company with a PEA, especially, and they say, okay, we've done the PEA, say it's a gold company, and we've used $3,000 an ounce gold. And here are costs, both in terms of CapEx, OpEx, and at $3,000 gold, this is what it looks like. But at $5,000 gold, look at us, we're printing money. Well, the reality is your PEA stage, it's going to probably be at least 5 years before you're in production. Maybe gold is $5,000 at that point, but I can assure you that if it is, or it's higher, the cost to build that mine is in 5 years, probably going to be double, and your costs are going to be double and your margins are going to shrink. And guess what? Your NPV isn't what you're claiming that it could be today. So, I think it's bogus. And as a result of that, um, the upside potential on those projects isn't really as much as what people think they are. And, you always have to think, if you're wrong, what happens? If gold goes to $3,000 an ounce, okay. On the juniors, I've got a lot of downside. I've got less downside on the producers. So risk reward, right now I'll take producers. There are exceptions in the exploration stage projects or exploration space. So, somebody with a new discovery, in a good jurisdiction, good grades, good size. Yeah, there's value to that. And the great thing is there's lots of capital available, or at least there has been until recently, where you can raise money and you can actually go and drill that and you can see what's there. So those are the select opportunities where I do see value in the exploration stage. But I think, risk reward wise, it's the producers. Normally I would like royalty companies, a little bit more boring, the lower risk. But, the thing with the royalty companies and the streamers right now is they are generating so much cash flow and they need to put it to work, and they're putting it to work in an environment where spot prices are over $4,000 an ounce. And so, if metal prices go higher, they will benefit from that. But again, if prices go lower, they'll make money, but not nearly what they've invested in. So all that to say, I think exploration, very select opportunities, and the sweet spot right now is producers. And I think they're trading at, I haven't checked now, but I'd say they're probably trading at maybe 6 times cash flow, which is not expensive. In a bull market and past bull markets, that could easily go to 10 or more. So there's upside on that. I think there's upside on the commodity price. So far, they've been disciplined in terms of M&A, which hasn't always been the case in cycles. I like the producers.
So let's go there next. If we think about mergers and acquisitions, I've heard Michael Gentile say many times that in the past couple of years, all these companies, especially all these producers, they've been more conservative, disciplined, as you mentioned. But now it seems like their rifles are out and they're kind of looking around. So what's your thought on the upcoming year? Do you see that playing out even with all the news that's coming out right now in the mainstream of geopolitics?
Yeah, so I think on the M&A front, from the last bull market, which was the major bull market, which was early 2000s to 2011, there were some really bad deals that were done. And those companies were told, don't ever do that again. They were in the penalty box for a long time. So I think current management teams at the senior producers, recognize that they've been told and continue to be told by big investors that return of capital is more important than deploying, cash at any cost. Because sometimes that's what happens, right? And I think, you can blame the producers for, what happened in 2000s. During the tech bubble, you can blame tech companies, but the reality also is, what investors want, right? And so in, say, 2007 or 2011, I think a lot of investors, because they were pulling in money into their funds, they were saying, hey, we want you guys to grow. Gold prices or metal prices are going up. We want you to grow, show production growth, and bigger is better, et cetera. And so the companies did that. And paid the price, and then the investors pulled out their money, scorned the companies. There's some shared blame, but the company management teams and boards are much more responsible and have learned now. So I think you'll see more. There will be more M&A, but that M&A is skewed towards. There's such a big passive component to the market right now, so index inclusion is super important. So bigger really is better in terms of just attracting capital and trading. And especially more kind of in the middle, pack of the producers. So you've seen companies like Equinox, very aggressively grow their business. And that's very good because as long as they're doing good deals, yeah, they're going to get, as they get bigger, they'll probably get a higher valuation, get re-rating, better liquidity, et cetera. So you'll see more of that, I think. Single asset producers merging with other single asset producers, you'll see some of that. And then aside from that, if you're looking more in terms of development pipeline, the reality in mining is you're always depleting your resources and you do need to renew those. But despite the bull market, it's the same as it always has been, which is good projects in good jurisdictions where you can actually build a mine and the government's not ever going to seize it. That's important. And then grade and size. So, I don't think that just because gold prices are over $4,000, that something that was a crappy deposit before because it was low grade or metallurgical challenged, or you had a community or environmental groups opposed to it. Just because the metal prices are higher doesn't make that any better of a project. It's not more likely to get acquired. It's still, the quality stuff. We saw that with Probe Gold in Quebec in a mining district. I was surprised by the acquirer. In that case, it was Fresnillo. Could have been Agnico Eagle, but still, it makes sense. And I think you'll see disciplined M&A. So advanced exploration projects, good quality resources that can be mined in good districts like in Ontario, Quebec, Nevada. Those are always appealing, and there'll be M&A, but hopefully it stays responsible.
I would love to get more of an understanding of how you ever even got into this world in terms of the financial world. Feel free to take it any way you want.
My background is quite unorthodox. And I think the reason for that is because what I follow is really, a couple of things. I've got immense intellectual curiosity. So, if I'm doing something and it becomes repetitive, I get bored and I say, okay, I want to do something else. You combine that with, I want to enjoy what I'm doing. And I want to, work with good people doing stuff that is fun. And then I believe the money will follow. So, in my career, I actually started I studied, had a joint degree in engineering and business. And then I really like finance better than the engineering side. So I followed that up down the road with an MBA and then a CFA. And I think I think very highly of the CFA program when it comes to investment. So I'm very intellectually curious and I'm super analytical, which you can tell with the engineering background, which I think is a very good platform for learning and problem solving, et cetera. But when I started out my career, I actually started in telecom and doing more of the engineering stuff. And, it was interesting. And probably within a few years, I was on a fast track to becoming an executive in telecommunications companies. And I realized, that isn't where I want to go. And so I was doing my MBA at the time, and then I shifted into corporate strategy, which I really enjoyed. It's, how can the company succeed? M&A, corporate development, all that stuff. That was during the late 90s, the tech boom, which ended abruptly. And so then I really liked investment. And so I shifted and became an equities analyst. Being Canada, a lot of that focus was on oil and gas and mining. And I tend to focus on small caps where this whole concept of inefficient markets and get as much information as you can to get an information advantage and exploit these market inefficiencies really started in my career. And then that led me to become an equities analyst on a proprietary trading desk. And that was wild because, like I said, I'm intellectually curious and I love studying things. Well, that was like drinking in a fire hose. And it's time sensitive because, stocks trade. They don't wait for you to analyze and decide what you want to do. And so I had a group of traders every day say, okay, give us ideas. What does this mean? Is it buy or sell? And the thing I love, in hindsight, probably didn't love it at the time, was when I started that role, I went to my bosses and I said, so, what do you guys want me to do? Because it was kind of a new role. They had all these traders, like more than 30 traders. And I came in as the analyst for all of it. And they said, oh, like I said, do you want me to do, large cap, small cap, primarily Canada, US, long, short? And they said, oh, we don't care. Like, just make money. And it wasn't really very helpful from a guidance perspective, obviously, but I love looking back at that now because at the end of the day, it's really what it's about, right? It's like, it doesn't matter, how you do it. It doesn't matter what I think about political groups or what the government is doing. It's just analyze it and how do you profit? Or I shouldn't just even say governments, but very much collectively investors, right? There's nothing I love better than when the market collectively makes a mistake or what I think is a mistake. And you can exploit that. I made a ton of money during COVID. I made other times too on certain pullbacks. And it wasn't because I took crazy risks. During COVID, I bought stuff that you could borrow money dirt cheap. And you buy things like Canadian banks, pipelines, and they're yielding high single digits or even double digits. I mean, you could buy debt. So, the question was, well, how long is it going to take for me to make my money back? But it wasn't really a question of, could I lose this money? It was the risk reward was phenomenal. So I love opportunities like that. But anyways, not getting off tangent, going back to your question. So then, being an analyst on the prop trading group, I invested the bank's capital. And it was fantastic. It was such a learning experience because one of the issues with sell side analysts is, you have this 12-month target, which is, somewhat bogus. And in trading, it was like, we don't care where it's going to be in 12 months. We just want to know on a day-to-day basis, are you making money or not? So it was a good gut check in terms of how confident are you in your convictions. And also, just speed up decisions, except when you're wrong. Things like that. But it was a great learning experience. And there are all these, I don't know what you want to call them, trading proverbs or tenets, like, the market could be irrational far longer than you can be solvent. And it's brilliant. It's so true. I could tell you something about a certain gold stock, let's say, and maybe in 5 years I'm right. But, in a year from now, it could completely implode. So you don't come out of that after 5 years and say, see, I was right. If you don't make money, it doesn't matter. That was the proprietary trading and research was really instrumental, I think, in shaping my career because I came out of that and trading in Canada at the time for a multitude of reasons really changed. But so I was looking to do something different. The other thing I'll mention is, I looked at working for the bank and I said, do I really want to do this? Is this, the money is great. But I kind of felt like I have to sell my soul and, conform to the big entity where, as opposed to just be your own person. And that wasn't my thing. So I said, you know what? I don't want to sell my soul. This isn't just about the money. And so I said, what am I going to do? I said, okay, well, what is it that I do? I exploit market inefficiencies. I try to analyze information, get an an advantage. And so what is the best sector for that I could possibly focus on? And the answer was mining. It's hyper cyclical and it's hyper complex, incredibly complex because you're looking at geology and the uncertainty of what that is. And even the best geologists, can't give you a good answer. There's still, massive amount of uncertainty. You've got things like metallurgy and jurisdiction and a management team, and and these things change over time too with jurisdictions and politics, et cetera, right? But what I realized is if you can really become an expert on most of these things and you can exploit these inefficiencies as well as the cyclicality of the sector, then there's a ton of money to be made. Now, it doesn't happen overnight. So I've kind of been playing the long game. And so it was 2011, 2012, really, that I pivoted and I said, okay, I'm going to focus on mining. I know quite a bit already, but I'm by no means an expert. And so I'm going to study it. And I'll study it both as an investor and from the inside. So I joined the industry. I've had a number of roles as consultant or corp dev, to being a director, or in the case of Aver Silver, going from consultant to interim CEO to chairman. But I've learned a tremendous amount. I'd say my investment acumen, or my odds, if you will, which is really what it boils down to, my odds get better and better. A big part of that also is my network. I've expanded my network. I figured out who to trust. I would say high risk sector for sure. But I'm confident that, with my background and with my skills and knowledge, that yes, I can find the opportunities, avoid the disasters, and over time make money. And so far, it was the case when I was on the prop trading desk. We made money consistently. We made a lot of money for the bank and ourselves. But then now, it is proving out in mining as well. And hopefully, it gets better and better and better.
So let's stay on the people. You mentioned there was a lot of brilliant minds that you've met along the way, whether that was in your early years or whether that's now. I always believe like we're the average of the top 5 people that we spend time with.
Yeah. So, it does change, but, along the way, when I was way back, when I was doing, corporate strategy and telecommunications, I had a boss who was young and brilliant, Harvard MBA, but, just great guy, humble. So he was a good inspiration. And that was one of the toughest reasons to leave that role is, it would have been nice to ride in his coattails, but he was heading in a certain direction that I didn't want to go in. The traders are a wild bunch, or were a wild bunch. But different styles and different approaches, but collectively, just tremendous in terms of education. So some people were technical traders. Some, came from the days of reading the tape. So it wasn't necessarily, one or two people who shaped my career. I'd actually say, it was many people. It was, all of this collective wisdom, or certain people. And, if you look in the mining sector, some people have a very broad understanding. So for example, Rick Rule, he's been around, he's done it all. And I think he's got great insights and is able to distill it into kind of simple concepts. But for the most part, you have people who are excellent geologists. And so, when you need understanding of geology, you go to them. There are other people who are amazing promoters. Guys like Robert Friedland, yeah, the guy it's amazing. I mean, as the saying goes, he can sell ice to Eskimos. Um, so, I mean, not that he's a mentor per se that I've ever worked for him, but you observe him and you see what he does. And you say, okay, maybe I can emulate at least a portion of that. So yeah, it would have been nice, I guess, in hindsight to have somebody I could pinpoint to where I said I worked for them and they taught me everything I know. But I think it's been, a lot of people over a long time.
I would love to dive a little bit deeper more in terms of the lessons you've learned over the years in terms of being a really great investor, and what are some of those principles or maybe list of rules that you've developed for yourself?
Geez, where to start? So I guess, yeah, if you're talking just investments, let me throw out a couple of concepts. So, I'm a more fundamentals guy overall, I would say. Obviously taking in all this information, by definition makes me kind of a fundamental investor. But yeah, I take in everything from the macro environment, what's going on in the world, to company specifics, et cetera, et cetera. Um, I'd say one of the things I've learned that I think is important is, um, and it goes back to that saying too, of the market could be irrational longer than you can be solvent. There's a tendency during market corrections or even individual stock corrections where you use another proverb, catch a falling knife, because you're like, hey, I know this is a good company and it just got a lot cheaper, so I better buy it. And it applies to the market as well. And so I've learned the hard way, it's not a good idea to catch falling knives because the market can be irrational. And so, one of the things I would say, important lesson that I've learned is, you wait for some sign of stability. And even though I don't necessarily believe that technical analysis is necessarily, say, I don't believe there's crazy aspects of technical analysis that I don't give much credence to, but in the absence of other information and short-term in the markets, technical analysis is amazing because it kind of signals to you how the market collectively or investors collectively are acting. And so when you have a situation where either the market is tanking or there's a stock you like that's tanking, I've learned you don't just buy it on the way down just because it looks cheap. You wait for some kind of signal that says, hey, the bottom is probably in and this thing is now going to go up. And so, yeah, you probably don't catch it at the bottom, but if you get a good price, it doesn't matter. And it actually diminishes your risk. So even things like, if you talk about technical analysis and people talk about support levels, well, why are there support levels? Sometimes it's as simple as, in the absence of other information, we like round numbers. So if the stock is at $11 and it's pulling back, it's probably going to have support at $10 because it's a nice round number. People are like, I don't know. It's going down, is good value. Maybe I'll buy it at 10. Or even moving averages, things like that. So it's investor psychology or behavioral analysis, which I'm a big believer in. But yeah, what that means is when things are tanking, especially markets, which have a little more efficiency, what you like to see is some indication that the bottom is in. And then you want to see a pattern of higher highs and higher lows. And then if you're wrong, you say, okay, I'm going to get out. I'm going to preserve my capital and I'm going to wait again. Because with markets, especially if they collapse, it tends to be in a cascade type pattern. And the last thing you want to do is ride that out because the losses mount so quickly. And so, for instance, with gold right now, you can look at the chart and you can kind of see support levels. And this goes back to the first part of the interview where I was saying, okay, overall, I'm kind of on hold. I'm going to wait for, obviously signals from the Middle East in terms of what's happening, but also from investors in terms of, does it look like gold has bottomed? Does it look like gold equities have bottomed? Does it look like, because I can't move the markets, right? So I want confirmation that other people are coming in, and then I'll join with them. And if we're right, we're going to ride it up. But yeah, don't catch falling knives. So that's one of the things I've learned. Technical analysis, like I said, is a very good tool in the short term. The other thing I like is, when you talk to investment advisors, they say don't time the market. In most cases, it's because they're no good at it. In reality, I time the market all the time. And it's, I'm not right all the time, but it's an odds thing. If I'm right 70% of the time and wrong 30%, that's pretty good. It's a hell of a lot better than gambling. Um, and even, if I like a stock and I want to buy it, I'll look at stochastics, which is just an oscillator. Yeah. Is something overbought, oversold? Maybe it's a momentum trade. You're better off just jumping in and riding it. But otherwise, I'd rather buy it when it's a little bit oversold if I want to own it long term. I'll get it in a better price. And over time, or I buy more shares. And over time, that makes a big difference. Compounding, whether it's interest or dividends or just those returns, over time has a massive, massive impact. Then, probably the biggest thing, I guess, from an investment perspective, it's all about risk reward. And when I started out, when I was an equities analyst, I was focused on small caps. And the theory was that and really micro caps, and the theory, at least in textbooks, is that when you take more risk, which you do with micro cap companies, then there's a potential for higher reward. Well, potentially, what I found is, in most cases, the risk wasn't justified by the returns, and it was terrible. It's if you had a diversified portfolio, and I think the same actually applies to exploration companies, like earlier stage. If you were to assemble a diversified basket of explorers or just any microcap stocks, you don't outperform the market over time, in my opinion. I think there's too much risk. There's not enough reward. So unless you're selective and you've got, this information advantage or something, in most cases, you're better off sticking with lower risk, companies and lower risk sectors. The reality is, if you're going to take risk, the reward has to be sufficient. And I think a lot of investors lose sight of that. I mean, that's the reason people play mining stocks, right? You want the 10 bag. But 10 baggers do happen. And right now, in this very positive bull market environment that we've seen over the past year, there are lots of them. So timing, I guess I had another point in there. Timing is hugely important, which again, I think was a trading tenet as well, in terms of, you can say, people say, don't fight the Fed, or don't fight the market, whatever. And it's true. If one of the best strategies for trading is momentum. And I used to run a quant portfolio as part of what I did, where I try to predict when something was on the verge of becoming momentum, because once it hits momentum, then it just keeps going up because it pulls in buyers. Fundamentals go out the window, and it's an easy trade. And you just have to recognize when the momentum is gone, which is, again, where technical analysis comes in, because it breaks the uptrend line. So you ride it for as long as you can. Trend gets broken, and then you get out and reassess later. Momentum is good, especially in the mining sector when liquidity is flowing in. It's wonderful. I can tell you when that liquidity leaves, it is terrible, because everything gets sold off. Quality, good, bad, everything gets sold off. So timing, absolutely key, especially in mining. And then, things that have momentum are much easier than, if you're hoping that, something lacks momentum or is being sold off, that it's going to turn around. If you're going to buy value, um, the reward certainly has to be worth the risk. So that's a whole bunch of stuff. Just throw it out there. But off the top of my head, those are just some of the things I've learned and apply and are key.
I really appreciate you sharing those lessons. I feel the more we always lean into lessons, the more we hopefully don't bang our head on the wall again and again and again. So I appreciate you sharing them. I want to transition a little bit where I know I've told you before, I really admire the work by Charlie Munger, but beyond even investing, he was really big on building these frameworks so you can make better decisions. And when it came to investing, it makes sense, right? Because space where you even touched upon it, behavior economics, where people could be so emotional. And when they're emotional, they can make really poor decisions. So I'd love to get your opinion on what are some mental models that you've used over the years that have helped you be a better decision maker.
Sure. Yeah. Say I haven't studied Charlie Munger's mental models, but in looking at his approach, I think I'm very like-minded. Um, so like I've mentioned a few times, I'm super analytical, but part of that analysis also applies back to me. So I'm always studying, okay, what am I doing? What can I do better? Where are the gaps? What's worked well, what hasn't worked. So that self-reflection, self-improvement, certainly constant learning, um, constant improvement. And I think, probably as part of that, humility. So, you don't, I think if you're of the mindset that you're the best and you're the expert and, you're right, which certain political leaders in the world currently may have that kind of hubris. But I think that's bad because it actually gets in your way. Right? It's, I've done well in the past in mining investment. Okay, well, that doesn't guarantee that for the rest of my life, I'm going to be an awesome mining investor. Things change. A lot of things change, right? So, I think it's good to be humble, get the opinions of others, always be learning, improving, refining your methods, etc. What goes hand in hand with that is, and I think Munger subscribed to this too, as well as, other investment gods, if you will. Invest in what you know, or invest in what you're comfortable with. You're going to understand it better, right? And it goes back to what I was saying before. It's like there's a lot of analogies between investment and gambling, but I much prefer investment over gambling. And you probably not likely to catch me at a casino because I know my odds are much better when it comes to invest. In part because the market tends to go up, but for other reasons as well. So again, if you know something, if you know something well, or if you believe in something, if you're using Chat GPT and you see the value of AI, then you say, okay, I love this. I think it's the future. Okay, that's great. So find ways to invest in that. If you think it's going to take over the world, act on that. Then otherwise, probably the biggest, I don't know, is a mental model or not, but, to me, my mental model is, also stay true to yourself, combined with just do things that make you happy. And so, that's really what I've followed. My career has been, I'm going to do things that are interesting and that for the most part I enjoy, and then I think success will follow. So, I'm not, unfortunately, I can't sing or I'm not artistic. So those things, were never on the table for me, but I love researching things, and it's not just investment, everything, if I buy a new coffee maker, I analyze it to death as well, but it's just in my nature. It's what I do, and it's what I enjoy. So pursue that, if, and really, I mean, I'd say if somebody, I love this industry, I love investment. It doesn't give me much stress other than maybe short term sometimes, but, if it's not like that for you, even if everybody else is doing it and making money, if you're losing sleep over it, let somebody else do it. Just enjoy life, pursue your dreams, pursue what makes you happy, whatever that is. Because life is short. Life is short, and hopefully you make the most of it.
I really appreciate you sharing those mental models. I think it really resonated with me in terms of circle of confidence, knowing what you know and knowing what you don't know. And also, I think it's tied to that, but even knowing thyself, which you just mentioned at the end. So it's good that you know your strengths. It's good that you know that you're so passionate about the investment world and having that logical approach, which obviously plays to your strength. Rob, I want to ask you a question. I'm curious if you have, let's say, a son, a daughter, a friend's daughter, or son, and they come up to you. They're like, "Hey, I've been learning more about the investment space, and are there any good books that you would recommend? That I could read, to just get started. What would be your recommendation?"
I probably haven't invested in a book for a long time. Um, so I'm not very helpful with my answer, probably. I mean, there's some classic books like Benjamin Graham, just, The Intelligent Investor and Security Analysis. I mean, those are kind of the foundation of everything we do. I mean, I've read books along the way on behavioral analysis, um, uh, technical analysis, things like that. I mean, early in my career too, um, I read The Wealthy Barber. Yeah, it's a very good book. I mean, this is when I was just at university and starting my career, and I thought, oh, that's pretty smart. Which is why now, in part, why the research service that I have is called The Wealthy Minder, because it sort of um, plays on that a little bit. But yeah, I found now, now AI is phenomenal just in terms of the research work I do, and compiling information and ideas. So yeah, I'd say these days, I don't really read books. Um, it's really more opinion, shorter pieces, what's happening. I guess, I'm a Bloomberg subscriber. So, it's just that rapid information, reading things on CNN, or sorry, not CNN, CNBC. But I guess related to that too, what I don't want to do is read anything that is maybe too narrow in scope. So yeah, there's stuff, we delve into geopolitics and stuff. Yeah, there's views on the left, views on the right, and I'll read them all. I'll see. It's really, you're trying to get into the minds of other people and other investors. And it doesn't, in the markets, it's not necessarily what's right or wrong. It's, what are people doing, the people with the money, and where are they going? And so even, let's say manipulation of the silver market, right? We can criticize it, but we're not going to change it. And so then it's really, trying to understand, okay, what is going on? And if you can't beat them, join them, or, position accordingly, right? It's, yeah, I guess, reading things, I read a lot, but it tends to be kind of conceptual and who's doing what. For example, Charlie Munger and Warren Buffett, they've got an approach very successful. And I agree with a tremendous amount of the things they do. I'm a fundamental guy, just like they're fundamentally driven. But my risk tolerance is much higher. My portfolio is much smaller, more nimble. So I'm going to do different things. I don't just want to emulate them, but um, and they're sitting on a hoard of cash, which I understand why, waiting for the right opportunities, and they're very patient. But for me, I don't want to be sitting on cash right now because we're talking about all the reasons that gold is going higher, and it relates to the value of cash going down. And yes, you can buy T-bills, which they hold, and you can collect short-term rate 3.7%. Well, I don't think that compensates you for the loss of purchasing power in those dollars. So, my kind of view on sitting on that big pile of cash is it's actually going down in value. I would much rather have that deployed in hard assets. So that's kind of how I'm invested. The only cash I have is really just for liquidity. And then I will shift and pivot in terms of what I'm invested in. But other than short-term cash, I'm not a believer in cash. So, just back to books. Unfortunately, I don't have good answers. Also read books on astrophysics and quantum mechanics, but that's to help me sleep. So to be honest, I haven't read any good investment books, but there's a lot of information out there, just, say on the web and podcasts in terms of really what people are doing. And I think it is important because as we're seeing right now, the market moves so quickly. And a book will capture a moment in time. You can study, okay, what happened during COVID and how do you position, that's fine. But I think it's important to be kind of in the moment and forward looking.
Right. And I also think too, seeking knowledge in many different ways, like even you talking about, you're actually reading a lot, right? But you're not just, reading from books. So that's one source, right? Of acquiring knowledge, but we can do it, like you said, through podcasts as well as newsletter writers, all this stuff, right? There's so much abundance nowadays of access to information, right? So as long as you're finding sources that are credible, I think that's what matters. But I will highlight The Intelligent Investor by Benjamin Graham. I think anyone who ever decides to choose the path of investing, and especially you managing your own money, that's a must read. Those lessons are timeless. Books that I always recommend to friends and family. Rob, I want to transition to a final question. All titles aside, who is Rob Bruggeman?
Yeah, so it's funny because life evolves, and it. I guess I've changed over time and learned a lot. But who is Rob Bruggeman? I'm not necessarily on a quest to be famous or rich, which maybe I wouldn't have said in my 20s. But now what I've realized, I have 2 kids, and I'd say the biggest thing I strive for is just to be a good father and do what I can for them, because it gives me so much satisfaction. I love being a father. I love my kids. I love seeing them grow. And I think at the end of the day, in say, I don't know, 10 years, 20 years from now, when I'm looking back and saying, okay, looking at my life, was I successful? I have a sense that what they're doing and how I shape that will be far more meaningful for me than if, I made a whole pile of money, or, my name was well known or anything like that. It's my kids. I love that experience as well. And so, I'd say that's kind of what I've turned into. So it's, and I've always sort of said, work to live, not live to work. And that evolves. In my 20s and 30s, it was all directed at myself. I love sports. And so, played a lot of sports and traveled and did those things. But yeah, now it's moved more towards, okay, what can I do with my family? How can I lead by example? How can I set them up? So yeah, it's funny having kids. It's really become much more about them than that. I find so rewarding.
How old are your kids?
They're 13 and 15.
Okay, yeah. So teenagers, I'm seeing more and more, not only with their age group, but even I teach students who are 17 to 19 and they're really hungry for mentorship. How could we end off this conversation now on a more positive note? There's obviously stuff that we can control and stuff that we can't control. So how could we maybe end off this episode with a little bit more positive light and seeing the beauty in the world?
It kind of goes back to, we're all, what are we? One of 8 billion people on this planet, right? So unfortunately, there's not that much that we can do, but we do have a sphere of influence, and that applies to kids, or if I'm involved with a company, the employees, the shareholders, etc. And so I think, um, hopefully my legacy is that I've helped a number of those people in some way, whether it's, investors financially, if they're subscribers to the Wealthy Miner, that they've made money off some of the stock picks, or in the case of my kids, that, they're living happy lives, and however they want to define success, that they're successful. But yeah, I think, and so it's a very pragmatic kind of view. If one day I have billions of dollars, then obviously I'll, be more influential. I can give that money away and, help whatever I'm passionate about. But yeah, for the time being, it's just, I think, if all of us look at our sphere of influence, whether it be relatives, friends, children, or if you go a little broader, coworkers, employees, investors, just live the best life you can and help whoever you can, whether it's through, information or whatever else. But yeah, I think that, if we all did that, then obviously the world would be a much better place. There are things, everybody gets a vote. So, and everybody has different views, and I respect that. Different people have different priorities, but yeah, use your vote, or, if you don't like things, you also have feet, or there are other things you can do. Just, rather than complaining about things, do whatever you can to make, what you think is better. And don't, the things you can't control is another thing. I guess I guess would be a mental model. I try not to live a stressful life. So I don't stress over things that I can't control. I react to them. I minimize the impact. And then the things I do control, that's what I'll focus on. And so, I think, that's a good approach as well. And to answer your question, if you kind of apply that, it goes back to, with the things you can control, control them for the best, what you believe in. And hopefully, if a bunch of us do that, the world becomes a better place. And there's less of the bad stuff.
One thing that really resonated with me there was the whole ripple effect, right? Really knowing from what you can control, how could you maybe share that with someone else and have an impact on them? So I want to take this last little bit of time, Rob, to really thank you for being here.
Yeah, no, thank you for the platform. It was, it's stuff I loved and loved discussing. And so it was a lot of fun.
Awesome, Rob. We'll take care and we'll talk soon.
Sounds good. Thanks.